Hey everyone. Today we're going to be starting a new series where we talk about different tools blended with wave theory, blended with wave concepts and understanding of market structure. And we're going to start with the STRAT. These are two languages in many ways describing the same truths about price, about how markets work, about how price moves and markets function. So diving right in here, just to clarify, I'm no big STRAT expert. If you want to go deep on the STRAT, check out Alex or Sarah. I've left their handles here for you on Twitter. I'm going to talk about kind of the basics of the STRAT and how I implement it within my trading. But if you want to go deep, definitely go check those two traders out. They're great traders, educators, good people. So the basics of the STRAT, essentially the foundational idea is that there are only three ways a candle can form, and this is objectively true. Okay, we can have a directional candle. When we're looking at this candle here labeled 2, we see that it only takes out one side of the prior candle. So comparing it to the prior candle, it breaks up and it stays up. Okay, it doesn't come back through the other side. It only breaks one side or the other. And so this is what the STRAT calls a 2-bar. This would be a directional candle. Now, the second type, called a 1, the inside bar. This is essentially when the range of a candle is within the range of the prior candle. So notice how this does not escape the prior candle's range. It doesn't go anywhere. It stays within that prior candle's range. And the third type, the 3, is the outside bar, and this is the opposite, where it takes out both sides. Maybe it takes out the low and then rallies back to take out the high, or vice versa. And so with these three types of candles, there are all sorts of different combinations. Okay, a 2-2, where it's a 2 followed by another 2, and that creates an actionable trigger. Okay, maybe a 1-2, where we have an inside bar, and that's broken, and that's an actionable trigger within the STRAT. And there's all sorts of different types of combos, ways to combine these candles and make them actionable in certain circumstances. And of course, the STRAT has different ways to identify context and understand full time frame continuity and when and where to look for these actionable combinations. You've seen me use them in how I trade in the hunting leg after a reversal structure. And so there's a bunch of different ways to utilize these candle combinations. And one thing the STRAT talks about that I align with a lot is the broadening formation. And this is a concept, theory, a truth that price will expand over time, that the ranges will expand and create these broadening formations. This is something Alex in particular talks about a ton. And if you're looking at this formation here from a wave perspective, you might recognize this as very familiar. You might be noticing something very similar here. That's because it is almost identical to flats. Flats being traps. We talk about expanded flats sweeping both sides of the range, sweeping the high, coming back through the low, and then resuming the prior trend. Or if we are in a downtrend, we simply flip it upside down. And so broadening formations and the flat are essentially saying the same thing, that the range is going to expand. So why do these two concepts, why does the STRAT and wave why did they both say the same thing? Is one copying the other? Did the STRAT copy wave theory? No, of course not. Both are observing the same truth about price, the same truth that markets need liquidity to operate. Let me illustrate for a second here. If we see this range, what are the two ways that a range can resolve? We've talked about this in other videos before. Okay, we can have a direct breakout where price breaks above, maybe pauses and is accepted. Buyers essentially concede, I'm not going to be offered a better price, might as well step in here and chase price higher. And that can lead to a direct breakout. Okay, but what if that doesn't happen? What if price gets back up here and buyers say, no way, that's too expensive. I'm not willing to pay above the prior high. I'm going to wait for a better price. Notice that in this situation, there is a ton of pressure put on all of the shorts from in this area. Okay, these guys are going to be forced out of their shorts, liquidated from their shorts, forcing them to press the buy button, meaning that anyone up in here who wants to get short is getting offered a great price. They don't have to chase it. All of these fresh buy orders are coming in from the shorts that are getting stopped out, providing liquidity for them to step in at a great price, a very attractive price. And so in this instance, say sellers step back in, price slips back into the range. Now who's the pressure on? Who is in trouble here in this situation? All of the longs from this area. And so all of the longs from this area, they've already fired their bullets, so to speak. They're going to be less likely to keep adding to their long position. Instead, when price comes back to their entry, we're going to see longs getting stopped out. And again, when getting stopped out, you have to go the other way. You have to sell to close that long, and that's just going to amplify this selling back to the other side of the range. We get to the other side of the range, these longs have been stopped out, a ton of liquidity is provided. So if there are buyers in this area, they're getting a great price. Okay, and especially when coming from an existing uptrend, if we see buyers step in, then trend can resume. And so this is why we see broadening formations. This is why we see flat corrections. This is essentially how markets operate. And this pattern doesn't play out 100% of the time. This isn't every single moment of every single day, of course, but we see this quite frequently because it's how markets have to operate. Markets have to find liquidity to move, and this is a very frequent way in which markets find liquidity. So a strat trader might take advantage of this broadening formation by waiting for a strat style trigger back the other way. When the broadening formation, when it reaches its extreme, okay, up here at the high, say, and forms a 2-1-2 down, this could be actionable, looking for the other side of the range. Conversely, when the bottom of the broadening formation is reached, maybe we get a 2-2 to the upside, and that can be actionable. And so that's an example of how a strat trader might trade this. When we look at wave, we look at how I trade. Okay, we sweep the high or come close to the high and fail and get a reversal structure. The next leg is the hunting leg. I'm looking for a trigger. Okay, on the other side, sweeps the low for the C wave, reversal structure, looking for a hunting leg, looking for a trigger within. So if we blend these two together, we get something like this, where we have, let's say we identify control up, we get a flat correction, aka a broadening formation. We sweep the A wave low, reclaim the range, essentially confirming buyers stepping back in, liquidity has been taken, all of that, followed by a strat style actionable signal. Okay, this can be a long opportunity within the context of wave, within the context of the strat, looking for resumption of the prior trend. You know, depending on the situation, maybe this is a wave 1, maybe this is a wave 2. We can target the high and then look even higher for wave 3. And so this is an example of how a trader could blend these two things, these two concepts, the strat and wave, and come up with a pretty similar result in either case. Whether you're trading a flat based on a reversal structure and a hunting leg, or you're trading a broadening formation based on the strat candle combos, both are essentially doing the same thing. We're identifying where previous longs are being stopped out, liquidity is provided for fresh buyers to step back in, and price to expand the range to the other side. And so it's a slightly different language, a slightly different approach, but essentially the same thing is being done in either case. It's just a little bit different of how a trader takes advantage of it. And so each style is going to have some pros and some cons. If we look at waiting for a reversal structure, this requires a little bit more focus on the lower degree, maybe a little bit harder to find that entry. If it gets messy, maybe there's not going to be an entry provided, but the risk is going to be a little bit more refined, meaning the risk-reward ratio is going to be more in our favor. Okay, the strat style might provide more triggers, more opportunity. It's a little bit simpler, a little bit easier to spot, a little bit of something, let's say maybe you don't have as much time to watch the lower degree price action unfold, maybe you want to stay on the higher time frame charts relative to the setup, this could be a great option. And so again, they're basically doing the same thing. They're reading price in the same way. They're just different styles of how to take advantage. And I'm not advocating for you to do one or the other. You can explore this however you want. Maybe you blend it in with your system. Maybe you use it in some cases. Maybe you use it fully. Maybe you don't use it at all. The point is there are various ways to achieve the same things within trading. All right, jumping into an example here. This is one you've probably seen before. This is Palantir, where we have a flat correction that formed within the context of an uptrend. So control is up, trend is up on the higher degree overall, and then we get this flat correction. We get a corrective move down, corrective move back through that prior high, and a sharp move to seek the other side of the range. We have buyers failing to sustain above the prior high. They fail up here. Okay, and price then comes back through to seek the other side of the range to grab that liquidity. All right, so in this situation, within how I trade, my approach is and was to drop down to a lower time frame, lower degree, and watch for a reversal structure. So we see that form fairly quickly. Okay, we have our downtrend, low time frame downtrend, lower relative to the situation, time frame downtrend being formed, being broken. A higher low is formed here, and then all I need is an entry trigger, and I get that shortly after with this fair value gap. And so in this instance, entry would be here, stops are going to be here, and my target was the prior high. At this time was all-time highs. So that's the setup. Price comes in, fills the long, and rallies back through the prior high. So in this style, this trade, this provides, let's see here, roughly 5R. Okay, 5R in profit. Okay, a solid trade. Very happy with that result. Now let's take a look at it from the STRAT style perspective. Okay, so looking at this same situation, the same setup, but from more of a STRAT perspective, when price sweeps that prior low, sweeps liquidity, and then gets back into the range, okay, reclaims the range, the STRAT trader is now looking for an actionable trigger. And just for the record here, the 195-minute chart, that splits the day into two equal candles. It's very close to a three-hour time frame, just splits it into equal candles. Anyways, the next candle that forms, when we get back into the range, we gap up back into the range, this is an inside bar. This candle does not escape the range of the prior candle. And so when this is broken to the upside, that is a 1-2 combo, or a 2-1-2 if you include this candle here, trigger to the upside. And so when broken to the upside on the next candle, this could trigger entry, stops at the bottom of the inside candle, and the trade is set. And so targeting the upper end of this broadening formation, price runs through to target. So this trade produces just under 3R, another quality way to participate in this move. And again, both styles are based on the same concepts of what's happening between buyers and sellers. Both are taking advantage of the same thing, just with a little bit of a different language between them, a little bit of a different approach in terms of time frame, how risk is refined, all of those things, but both achieve essentially the same form of participation within this move. So in conclusion, both the STRAT and Wave are both two languages describing the same truths about the market. The markets don't follow wave theory. They don't follow the STRAT. There's not some secret code built in. Market makers aren't behind a curtain pressing buttons based on the STRAT or wave theory. These are both two styles of defining, describing, categorizing, quantifying what happens between buyers and sellers. And that's why these concepts work, and that's why they share so many similarities, is because they are languages to describe how markets work. So hopefully this helps. Hopefully this gives you a little bit more of an understanding of Wave and the Strat and how you can bring other tools into your trading based on understanding market structure, liquidity, all of those things. As always, thanks for watching. Have a good one.